Welcome again. Today we have our speakers here, Bruce Werger. We are honored to have Bruce with us on this panel today. Bruce is an accomplished executive and leader spanning fintech, software, insurance, and beyond. A CEO of Title III funds, he is a pioneer in democratizing private company investing, enabling everyday investors to capitalize on the potential of emerging businesses. A veteran of scaling and startups internationally, Bruce's expertise in navigating regulatory landscapes and fostering a culture of trust and excellence has solidified Title III funds as a trusted resource for both investors and companies. Next to Bruce, we have Mark. Mark Lee is an investor at Mucker Capital, one of Southern California's leading early-stage VC firms, investing in pre-seed through Series A companies. He also advises companies in go-to-market, product management, and marketing. Previously, Mark founded Enroll Hero, a tech star and VC-backed Medicare insurance startup. Mark has also had product leadership roles at eBay, PayPal, Visa, and startups including OVO Group in London, where he helped to grow the company from 100K customers to 1 million customers. Mark lives in San Diego and holds a BS in computer science from University of California, San Diego. Next to Mark is Brandon. Brandon is a co-founder and general partner of Sunset Ventures, an early-stage venture fund based in Los Angeles and San Francisco, focused on the future of gaming, finance, and commerce. Sunset backs uncommon founders using frontier technology to redefine the internet. Last but not the least, we have Dylan. Dylan is a director with Snack Fund, where he manages a global portfolio of 75 active companies ranging from seed to pre-IPO. He has contributed to 70 of Snack Fund's 110 lifetime investments since inception by either directly sourcing, performing diligence, executing on the investment, and providing portfolio support. So welcome to the panel.
Thank you.
All right. So let's start with sharing some of your background in the early stage funding. Bruce, would you like to go first?
My background in early stage funding is I've bootstrapped my own companies, never...
Can you...
Is that better?
Yes. Mm-hmm.
I've always bootstrapped my own companies, have not sought outside funding, but when I exited my companies, I was better off, I think, for that. And now I've been in the crowdfunding industry since 2019, trying to help startups navigate the landscape of crowdfunding particularly, but learning about all of the other areas of raising capital for founders as well, and networking with VCs, angel groups, and trying to hand off deals that might be good for them.
Mark?
Cool. Maybe just a temperature check. Who's a founder? Okay, almost everyone. Who's launched? Okay. Yeah. So I'm Mark. I work for Mucker Capital. Previously, I founded a company in the Medicare space. We look at kind of pre-seed through Series A investments. So anything from 100K checks to like $2 to $5 million checks. So we're like $200 to $300 million fund. But our bread and butter is like they're the seed round checks. That's where the partners, Will and Eric, have kind of focused a lot of their energy and time to help founders. And we've had some pretty big exits, which like Honey is one of the bigger ones, kind of in Southern California, where they started off as this like these guys, nice guys, who were just building a Chrome plugin, and then you know what it became was a $4 billion sale to PayPal. And so we were first check-in that one, and we helped them kind of along the way. Not me personally, the partners did, but it's an example of us like providing kind of our mentorship and like our founder focus to just help companies along and founders to kind of achieve, kind of help them achieve what they're setting out to achieve.
Yeah, my experience with early stage startups started really at Morgan Stanley. I was an equity research analyst there, covered the consumer internet sector. So Mary Meeker's old team from 20 years ago. Learned a ton there, especially with IPOs. So I was able to work on some deals like Blue Apron, Snap, Spotify, and really then started to make my way earlier and earlier, but that's always kind of been my frame of reference. I was introduced to venture really in New York while I was there working at Harlem Capital when they were first getting off the ground over there, which really inspired me, spoke to me. It's why I didn't go work at a hedge fund, like a lot of my friends leaving sell-side research, and wanted to really be on the cutting edge and steer innovation and capital into the hands of founders wanting to change the world, not just have a bunch of ticker tape behind me. And so from there, I went to Samsung. I was at Samsung for about 5 years, based in Mountain View, and then a few years back home here in SoCal, remote, in the corporate venture arm over there. So I probably did about 20 deals or so on the platform, one of which was Wonder Dynamics, which actually just got acquired 2 days ago by Autodesk. And there had a chance to, again, work with pre-seed, seed, Series A founders for the most part, who were mostly digital consumer kind of experiences and services. Outside of that, I'd built an angel group called Diverse Angels, did about 50 plus deals in that group over a few years, focused on supporting underrepresented founders, specifically people of color and women in the US. And then about 1.5 years ago, started Sunset Ventures after spinning out of Samsung. So I've had a few vantage points along the way and found myself going earlier and earlier. Grew up in SoCal and knew I always wanted to come back here after some time in Wall Street and Silicon Valley. And that's what's brought me here today. I really want to see the SoCal ecosystem really win and grow. And so I've been investing all these years in many companies out here and plan to keep doing so.
Thank you, Brandon. Dylan?
Some great backgrounds. Nice to meet everyone. I'm Dylan Ferdinandi. My first introduction to startups was actually joining one. Right out of college, I didn't quite know what I wanted to do, but I knew that I needed a job. And through kind of some networking and connections, I found myself as employee 10 at a startup that was in the kind of the design and developer tooling space. And that was my introduction to kind of doing everything. I was kind of the utility player at the company. I did everything from talking to customers, figuring out billing issues, collecting payments, doing the dishes, learning about product management, all those things to help the company run. They were a True Ventures-backed company that was eventually sold to Adobe, and I spent some years there as Creative Cloud was getting started. After that, I went to a company that was backed by Union Square Ventures. It was called Zamanta. It was more in the ad tech space. Again, a very early employee there. Still kind of a little bit of the utility player, but focusing on working on some of our strategic partnerships. There, I kind of saw the startup journey of scaling up, scaling down, changing strategies, trying to scale up again. The challenges of raising capital, especially when things aren't, always up and to the right. I spent a few years there, and then ultimately joined Slack, where I've been working for about a little over 8 years. I originally joined as an operator. I worked on our platform and helped run a lot of the developer programs where folks were building apps on top of our platform and working with our APIs. I also worked on a lot of our internationalization of the product. And in the early days, Slack was really focused on the success of its developer platform. And outside of having a team that at the time that I worked on, and great APIs, great documentation, great community, we thought that having a fund would be a really great way to show a lot of the early stage startups that Slack had some skin in the game in their success. And so we launched a fund. The fund's a little over 8 years old, started very strategic in nature, investing in apps in our ecosystem. And as we saw some success, we've really evolved over these past 8 years to just being an early stage venture fund. So moving from kind of small participatory checks to leading and co-leading early stage rounds. So we focus on pre-seed through early Series A. We've have a portfolio of about 75 active companies. Hopefully some of you use those products like a Lattice, a 1Password, a Loom, a High Touch, and so on. We're part of the Salesforce Ventures organization today. Salesforce, I think they've deployed about $5 billion globally. Some of their more recent investments are companies like Hugging Face, Runway, Together, things like that. Focus on a little bit more at the growth stage. Yeah, thanks for having me.
All right, thank you for being here. So as we see that we have 3 different ways founders can raise funds. So what are the major differences between crowdfunding, VC, and corporate VC?
I can start talking about crowdfunding.
Sure.
It's my expertise. Well, with crowdfunding, you don't have to be a startup. In fact, you're probably not the earliest stage startup. You really have to have a community of people already that knows about you that you can invite in to be an investor in your company. So the way that crowdfunding works, and we're talking about equity crowdfunding versus something like Kickstarter, which is rewards-based crowdfunding. The way equity crowdfunding works is you have to do a filing with the SEC. You have to have an independent CPA review your financials, things like that. So it's not an easy undertaking, but what we're trying to explain to founders is let's build the community before you try it, because otherwise it's not going to work and you're just going to be disappointed. So the most important thing that I can say today is you have to have a significant community. In other words, you bring the crowd.
On the VC side?
Well, I think venture capital is, I think for startup founders, like most of you in the room, I think you guys probably heard and read a lot about it, but it's just, we're the rocket fuel. I guess like any VC would be, when you're ready for that rocket fuel in your company, you put it in and then you grow with it, right? So it's like we do advise. Now we have an incubator where we kind of help them to slowly funnel that rocket fuel in, but ultimately it's about growth. And so, when you look at other forms like earlier stage investments, like when you're ready for someone like Mucker, you're going to get like mentorship to help you to spend the money, spend it wisely, especially in this environment. But we want growth. We want you to get to the next level, not necessarily at all costs, but we want you to do it responsibly, but to get the kind of outcomes that everyone wants, we want you to kind of really go for it. Spend the money in a wise way, but spend it.
From the VC standpoint, at the early stage, I think something that's happened over the last few years, even just early stage or seed is almost not specific enough, frankly. There are a good number of pre-seed funds dedicated to pre-seed that are popping up. It's emerged, you could say, even as a stage of its own, although sometimes on VC Twitter, folks will debate that. The OGs, I don't think are a fan. But it's real. There's funds focused on helping founders get that first $1 million in capital. Frankly, the risk reward profile is different. The things that they're going to be looking for, it is mostly a founder bet at that point in time, right? A unique insight, maybe just an idea, might be a prototype, maybe very primitive, even wireframes or just something, or customer discovery. Could simply be enough, right? If you can really show and demonstrate proof points, that are actionable. Just show that there's an opportunity there from really understanding the problem from a consumer or from a customer set. Then there's seed, and seed I think has gotten bigger. There's more dollars at play, a bit more competitive perhaps. The size of those rounds on average are almost at least 3 million, 3, 4, 5, let's say, sometimes even more. And even after that, there's this giant gap, to get to A, so much so that there's even a third round. Some call it a bridge, which is probably the scariest, view of it. An extension, a seed plus, a post-seed. There are very few funds that focus just on that, something like bullpen capital, for instance. And the reason is, A, I think, is that pivotal round that kind of defines, especially early stage, and you go from a startup to a business, from a founder to a CEO, and you have product market fit. But it's been shown that there, on average, are 3 rounds of funding till you get to the A. And again, there's a very small percentage that even make it to the A. So it depends where you're at in the journey. And then I think it depends how much capital you actually need, right? I would say raise as little as you need. Try to keep as much of your company, but also just be frugal, every dollar to just test experiments fast along the way, especially early on. You'll be likely in a better position, but it is always hard from VCs. Even on crowdfunding platforms, it can be hard. If you have a community, though, take full advantage. There are companies that have done that. Gumroad, I think, was a very popular one that did. Even recently, Beehive has made some noise, being a newsletter platform, and then they even purposely gave some of their company to the community using crowdfunding platforms. I think WeFunder, maybe for that one. So again, I'd say it depends where you're at in this stage, but early stage is not a catch-all. Really get, I would say, granular with where you're at, what you need, and go from there.
I'd agree with a lot of what's been said so far. I think the one thing I would add too is, as you're starting to think about, maybe if some of you are in the kind of the ideation phase right now, is really also just considering, like, is venture capital the right option for you? Do you want to raise capital from outside investors? And how fast do you want to grow? And just kind of understanding how venture capital works, in that what investors are looking for is really that that grand slam, and that it's really a power law business, and investors, depending on the fund, will have 20 to 30 investments that they're making, with the goal of one ideally, but or hopefully a couple more that are mega winners, and most of the others return, most likely fold or return a little bit of capital back. But what investors are looking for is the potential for these outlier type outcomes. And so I think one thing that I spent some time talking to founders as they're starting to get think about building a product, or they're thinking about going to market, is this the right option for them, before they even go out and start raising financing. And then from there, you can go into the right strategy, the right investors to talk to, and all those kinds of things.
So related to right investors to talk to, what are the best practices for founders to look into what type of investors they should work with?
I can jump in. Part of it's stage, right? I think as you're, I think there's a few things, right? Stage is a big one. Another could be, the category, and another I would think about is like the right person at the firm. So I guess maybe at the start, right, kind of knowing who you want to target. And so if you're kind of in the this pre-seed or seed stage, targeting funds that are I would say likely a little bit smaller, will be able to spend a little bit more time with you, kind of help you, maybe find some of your first customers, help you go to market, and then help position you to start working with some of the larger multi-stage funds. Another area to think about would be the category itself. There's a lot of funds that are a little bit more generalist, and that might be perfect fit for you. Others are hyper-focused and have a very specific thesis around how they view the world, or a specific category that they're investing in, say maybe crypto or fintech or climate. And so if you're building in that area, that could be a really great fit, and it might be worth trying to identify who some of those funds are and targeting them. It might also save you some time in not targeting some of the ones that you can see that are outside of your your focus area. And then the last would just be the partner or the person at the fund. Especially if you're engaging with some of the larger funds where it's not just a couple general partners. If you're building a B2B software product, finding the investors there that focus on enterprise software. I've seen a lot of even companies in our portfolio kind of hit a wall with certain funds that we know are a really great fit for them because their entrance to the fund was through a partner that was maybe focused on fintech or something else. And so like really trying to kind of hone in on some of those areas that that can like kind of set you up for success. But I'd add those are all ideal scenarios. At the end of the day, you kind of just have to just make it happen too.
I can maybe just add a couple things. One is I think Dylan kind of pointed out like the strategic investors that can help you with distribution in your particular industry, vertical, whatever. A lot of times that's very beneficial, especially if they could be a great channel partner or connect you with their customers or whatever. And then second, I would say you should look at the investments as like it is marriage to some extent. You guys are signing on the dotted line, and like you want to make sure you want to wake up next to this person like every day. Right? Because it's really messy to try to divorce them. And so like you just have to like the other person. Like if you don't get the right feeling when you're looking at them in the eyes, like there are plenty of other investors out there, right? Like it's a marriage. Once you sign, like you gotta look them in the face, right? Like no makeup. And so you guys just gotta make sure you're getting the right person in bed.
The only other stakeholder maybe that hasn't been mentioned are angels. So again, very early on, angels make a ton of sense, right? Friends and family and angels, really individuals are probably going to be some of your first dollars to back you. And to be honest, if you struggle to even convince some of them, right, might be a sign, work on the pitch, because it is only going to get harder. The bar is going to be a lot higher for those that are professional investors, right? They invest in 1 out of every 100 deals that they see, or at least that passes, their desk at the VC level. And so with angels, really just start from some type of place of common ground. Might be an alma mater, might be geography, maybe it's your industry. Find a connection, right? Be scrappy, and you might even want to go to successful founders, right, that are within some of those areas of overlap where you have that connection, because they know best. What that journey's like. When you're really 0 to 1, they can empathize. Generally, they pay it forward. Somebody did to them, likely, and don't worry even as much about how much money they give you, because the attribution of the value that they can bring may actually lead to a lot more money, right? A $10,000 check from someone very well connected could lead to $500,000, down the line. And if they were to be a warm referral and say, I've got skin in the game on this person, the amount of money doesn't matter. But by doing that, it could be the right way to start relationships, frankly, with investors. And again, if it's a successful founder, they've been on the grind for probably 10 years. They had many investors invest in them. They know many investors, even those that have passed, but they just know them. And so that would probably be a good conduit, to get in front of VCs. So,
what are some of the in the roadmap of raising funds? What are some of the ingredients that you would say that founders should have in their plan to make them more attractive to the VCs?
I can jump in. I think, again, it really depends on kind of the stage that you're at in your business. For us, where we invest, it's kind of around sometimes at the inception stage, but ideally that most times the founders have taken some angel money or friends and family or kind of former colleagues, and they've built their product. And I think for us, it's really seeing like that they actually have built a product, and they may ideally have some pilot customers or some type of users that are getting value from it, that we can talk to, that we can validate it. That's the biggest one that I think that we focus on. And at least when I interact with a lot of other founders, like just doing everything you can to kind of de-risk the process by getting as far as possible on product and engaging with as many customers or potential buyers as possible.
I'll say something that isn't necessarily, I think, something that they've prepared, and is enticing for an investor. I'll give you a cheat code in terms of how you might want to prepare to best position yourself, which is create momentum. That is the job of a founder. It is hard, very hard to start momentum. And once you lose momentum, it's very hard to get it back. But that's what it takes, right? Momentum within your team, even your co-founders and your first hires, to build momentum with outreach and sales and bringing on customers, and especially momentum with investors. So what is momentum? The preparation that you're going to want to do is a lot of what's been discussed, right? So it is prep before you really even start raising, okay? What are all the investors in the universe? I mean, that makes some sense, and qualify them, just like you would qualify leads, right? For a funnel. Figure out then what that list looks like. Find then a column of some type of mutual connection, right? Even if it's work then to get to that connection. But ideally, you're going to get some folks that make these introductions. Once you have this list, though, you carve out time on your calendar and you make it a sprint. Again, just like you would from a product development side of things. It is a 2 to 4 week, condensed period. You should stack the calendar, stack the outreach, stack the connections and intros. What does this do? Again, you're going to have way more shots on goal in a short period of time. You're going to be able to show momentum in a matter of 1 or 2 weeks. That numerator over the denominator of how much you're trying to raise starts to go up and up. Even just your morale, frankly, and your confidence, you're going to be in a lot better position. And when any investor, even in week 3 out of that 4-week period, they see you've already done a lot, and then a week later you make it seem like, or you may very well have practically closed the round, they're going to feel that momentum as well. And the other thing that they're going to do is back channel. A lot of investors know each other. They ask other investors, have you seen this deal? Have you heard this deal? What do you think about this deal? Either, just wisdom of the crowd, and they know that they need to either move fast, they might not be an expert in some aspect of the stack within that industry, with knowing that customer base, and they're going to use that as a way to diligence, right? Just like they would talk to customers and talk to folks that might have worked with you as a person, get a reference check. This is sort of that investor reference check. It also even just gauges, are you investable, right? Some folks might be like, well, I'm a seed investor. That's too early for me, but that's kind of interesting. I haven't seen anybody do that. And if they get here, right, if they get 500,000 in ARR, that becomes real interesting. And actually bring it to me when and if they do. Now that pre-seed investor is like, okay, I wonder if this is capable of 500K. If so, I've done my job to the next milestone. So again, create momentum, do the prep work to do so. The investors will feel it. It's not something that's going to show up in that meeting itself, but that's kind of the cheat code, I would say.
I'll just add in a couple quick ones, couple just tips I would say. Like, we think about like the founder and the market. And so on the founder side, I mean, ultimately it's a people business. We have to like each other, we're gonna get married. So there just has to be excitement. You just have to be excited to talk about your product and how into it you are and all the details. You have to be able to go into all the numbers and details, because if you can't, then you're not proving that you're into it. And that's what separates a lot. It's like, you're so excited about this product, we can't stop thinking about it after we talk to you, right? So that's on the founder side. And the other one's market. You have to demonstrate how big the market could be, especially now, like with AI and all the possibilities of it. You have to paint the picture of how big the market is, and you're part of it, and to some extent how defensible it is. But like, you know, you got to paint that picture. If it's not a big enough market, it doesn't matter how good you are as a founder. You're just not gonna. It's not gonna excite the investors.
I think from a crowdfunding point of view, every customer you ever have, every person you're talking to about your business is a potential investor. Maybe not now, and I don't think it's VC money, angel money, or crowdfunding. It's a continuum, and when you're ready for crowdfunding. So as far as making lists, you have your Excel spreadsheet maybe, or CRM with your list of angels that you want to reach out to and your list of VCs that you want to reach out to. Well, open up another tab for potential crowdfund customers or potential crowdfund investors. And when you have a significant list, that's a time to perhaps test to see if that list might want to fund you. And you could raise a lot of money if you have a significant list and a good following. So think about when you're preparing your business and preparing to raise money, just make sure you keep that list too, because when crowdfunding, you're ready for crowdfunding, now you have it, and you don't have to start at a future time. You're starting now.
Yeah, as they say that your network is your net worth. So keep on building that network of yours. So just if you, each of you can take a minute to share any advice, final advice that you would give to founders who are looking to raise some funds. So Bruce.
Sure. So from the crowdfunding perspective, like I said earlier, it's not either or. This is, as a CEO, it's a tool in your toolkit. And you should learn you should learn what it's about, if it's for you and if it's not for you. Be careful of the salespeople that want you to go onto their platform. Just learn for yourself whether you're going to be successful, because it's going to be very disheartening to think you're going to go onto a platform, magic happens and you raise capital and all of a sudden nothing happens. It's because you didn't do your homework and you were just sold something. Really do your homework and figure out if crowdfunding is for you and if you're ready for it. And if you're not ready for it, learn how to build it.
I think from the fundraising standpoint, I would just say, you know, treat it like it's a job. It's a specific, it's an activity that you have to focus. I mean, the CEO should be focusing like pretty much their whole time to it and treat it as a sales process. It's you know, have your funnel. You got to get all your leads on the top of the funnel. And you go through it methodically. You disqualify them as quick as you can, right? Just like sales, and you just, yeah, you kind of blast through it. And it's a numbers game. You know, don't get, you know, you're not gonna date all the pretty girls out there in the same way, or boys. And in the same way, like, you know, you could fall in love with Andreessen, but you know the likelihood is low, right? So you just got to date a lot, and then you know, see if you can get someone in the hopper.
I'll probably reiterate a couple of things I said. So again, just create that momentum and really be particular with how much money you actually need, not how much you want or how much peers or how much on average is getting raised in that round or geography. And frankly, try to build and get as far as you can before you take institutional money from VCs. You should not feel as though that is the limiting factor to get out the gate. The starting blocks. You should be able to do that on your own. Many have proven to be able to do so. There's a lot of tools out there, you know, in this day and age, to be able to get pretty far, frankly, without it. The farther you get, the better off you're going to be once you get in front of VCs.
One heuristic we use as a team when we're meeting with founders is kind of, does the conversation get better, like with each following interaction, you know? And I think that the same can be said for founders and when you're meeting investors. And obviously it is a numbers game, but like ideally you're not giving the same pitch again to those same investors. Like ideally they're coming a little bit more prepared. They've like read your go-to-market plan. They have some like detailed questions. And you know, hopefully you'll find a few of those in your process. And if you do, like I would really work on spending more time building a relationship with those folks. and ideally kind of measuring, is each conversation getting a little bit better? And I think you might find yourself in a good place. Thanks.
All right, thank you for sharing all your experiences and wisdom. Hopefully it was helpful for the audience to have a pathway to move forward in terms of raising funds for their companies and their ventures. And we have talked about 3 different options from the VC funding, corporate VCs, and crowdfunding. So hopefully it was beneficial. And if you have any specific questions, these speakers will be around. You can ask them outside there. Thank you.